Welcome to our first pension focus session, in which we're going to discuss some of the rule changes that were announced in the spring budget, and also longer term what opportunities there are for savings and pensions as a result of this. My name is Rachel O'Donoghue. I head up the financial planning team here at Buzzicott, and I'm joined by my colleagues.
So I'm Neil Lees, an Associate Director in the Private Client team.
I'm Ben Waters, Partner in the Financial Planning team.
Trevor Egan, Partner in the Buzzicott Expatriate Tech Services team.
So in this session, as I said, we'll look at the opportunities that arise as a result of the rule changes, but we're also going to look at the tax benefits offered by pensions, focusing on tax relief, also on some planning points for US citizens, and specifically as well looking at passing on wealth through generations. So in terms of the rule changes, as mentioned earlier, the spring budget introduced quite significant rule changes, and it's safe to say that many of these were quite unexpected. We've summarised many of these on our website and in various insights, but I think it would be useful today, seeing as we have you all here, to go through these in a little bit more detail. And in particular, Ben, if you wouldn't mind going through the key changes and specifically what these mean for clients.
Yeah, of course, Rachel. I think the biggest surprise of the budget announcement was the changes to the lifetime allowance. And those are that the lifetime allowance tax charge has been removed from this tax year, and the lifetime allowance itself is set to be removed from April next year. Now that's still to be confirmed in a future finance bill, and we're yet to understand the full extent of how the lifetime allowance framework will be removed, but it does present significant planning opportunities for those with larger pension pots who would have previously been hit by a lifetime allowance tax charge, which would have applied to any excess benefits above their lifetime allowance and could have been up to a 55% tax charge. Now, HMRC has announced that individuals with protection for their lifetime allowance, whether that's enhanced protection or one of the forms of fixed protection, will be able to keep that protection from this tax year and accrue further pension benefits, which they haven't been able to do for a long time. In addition, a change has been made to tax-free cash entitlement from pensions, and there's a cap that's been introduced for tax-free cash from this year of 268,275.
Nice round figure.
Yes, yeah, it's very precise, but it's actually 25% of the standard lifetime allowance currently. But those individuals with lifetime allowance protection will be able to keep any higher tax-free cash entitlement they have under that protection going forwards. So as well as the changes to the lifetime allowance, the annual allowance was also increased. That's been increased from 40,000 to 60,000 from this tax year. Tapering still applies, but the minimum tapered annual allowance has also been increased from 4,000 to 10,000. Tapering will apply at a higher level as well. The threshold for tapering has been increased from 240,000 to 260,000 of adjusted income for this tax year. And lastly, the money purchase annual allowance has been increased from 4,000 to 10,000 from this tax year. Now that only applies where you flexibly access pension benefits since April 2015 and won't apply for all, but it does give scope for individuals who've taken benefits from their pension to pay more into their pension in future.
Okay, that's really useful, Ben. Quite a lot of changes, obviously. And I think particularly you touched on the annual allowance and tapering. This is something, Neil, you'll know from clients that we've worked on before and their situations that has come up in the past in terms of questions we get from those about using their allowances. Have you seen much of that since all of the changes were introduced, or what the kind of queries that you're getting?
Yeah, definitely. I think clients have been particularly interested in, under the new rules, how much they can contribute into their pension each year. So as Ben mentioned, the annual allowance has gone from £40,000 to £60,000, but there is tapering for high-earning individuals. So the tapering works, it is quite complicated, but broadly it looks at your total adjusted income. So this is effectively all your earnings and your investment income plus any employer pension contributions. Now once that goes over the £260,000 threshold, the annual allowance is tapered such that once you're over 360,000 of adjusted income, the annual allowance is down to the minimum of 10,000. Now, the 10,000 minimum is still 6,000 more than the 4,000 minimum that applied before 6th of April. So it is still a rise, and that's why we're seeing high earners still interested in re-engaging with pension contributions. Now, there's also the point about unused annual allowances, because you can use any allowances that are unused in the previous 3 tax years, potentially in the current tax year. So you've got to look back as well as at the current situation. Now, just one point to mention, and it's a point that sometimes gets missed, is that the client does have to have relevant earnings in the year that the pension contribution is made. So this is a sort of the amount of pension contributions is the lower of the annual allowance or the relevant earnings. Now, relevant earnings is broadly employment or self-employment profits rather than investment income. So that's just one thing to make sure that in the year of the contribution you have sufficient relevant earnings to use your annual allowances.
I can see why clients are coming to ask for advice about it. Between adjusted income and relevant earnings, it's not simple, is it?
No, it's not. There's several potentially complicated definitions that we can assist clients with.
Yeah. Okay. And touching on the lifetime allowance that Ben alluded to, Trevor, obviously significant changes there, some immediate and maybe some that are due to come into force from next tax year. What kind of queries are you getting from clients in relation to that, or is it all straightforward and you're not getting any questions?
Well, yes, Rachel. Many of my clients with significant pension pots, with one of the enhanced protections, in order to maintain those enhanced protections for the last several years, they've not been contributing to pensions. They've frozen their contributions. It hasn't been the right answer. Now they're coming to us and saying, well, should we re-engage again? Should we be making our contributions? Should we be paying our 10K? That's the question I'm hearing.
And I don't know what your views are on that. Is it a simple question of, or answer of, yes, you should, or is there more to it than that?
Seldom simple, Rachel, as you know. On the face of it, yes, if they make their 10K contribution, then they'll get their £4,500 relief in the tax year. But the big imponderable is what's going to happen in the future. The Labour Party have pledged that they're going to revoke these reforms as and when and if they get into power. So the big question is, if the Labour Party do get in, if they revoke the reforms, if people have started paying in again, does that then violate their entitlement to the higher protections? That's a big question we don't have the answer to.
And I suppose, as you say, especially when there's been an announcement specifically by the Labour Party in terms of saying what would happen and with an election not too far in the future. I guess in summary, most of the rule changes are generally quite positive, but I guess the message is really that we need to look at individual situations and take advice and weigh up the benefits of doing something now and how you might be affected if there was a change in the future, but particularly with protection.
Well, yes, and as you say, there's an election next year,
Yeah.
and as we've already mentioned, it's possible to defer making contributions. So maybe the better answer at the moment is just to hold fire, to wait and see, reassess after the election, and then go from there. I mean, as I say, that may be the better answer. It's certainly the Conservative answer.
Yeah. Okay. So as you said, Trevor, obviously not necessarily completely straightforward in terms of what somebody should do, and obviously there's always a risk of what might happen in the next year or two. But on the flip side, just turning to you, Ben, are there any opportunities in terms of a certain window or planning that could be done before any potential changes might be introduced?
Yeah, I think there could be for certain individuals. I think it will depend very much on their individual circumstances, but there's a chance for some people who are perhaps nearing age 75 and can still make pension contributions to receive tax relief to do so in advance of their 75th birthday. And if that happens to fall before the election, then perhaps they're less at risk of a change in legislation affecting the total value of their pension benefits. Alternatively, there's scope for individuals to try to maximise pension contributions and then to crystallise their pension benefits and test them against any lifetime allowance. I think as we touched on it, it's difficult to say at the moment with certainty as to whether or not those are sensible things to do if there is a risk to future changes in legislation affecting the value of pension benefits. But there's certainly opportunities for some.
So it's looking at it really, I guess, on an individual basis, isn't it?
Quite.
Okay, thank you all. So Neil, we've talked before about the benefits of pensions and obviously from a tax relief point of view they can offer a very attractive way of saving for retirement. But I think it'd probably be worthwhile maybe just recapping a little bit on the detail of tax relief, and in particular how you see it benefiting your clients, because it can sometimes be complicated depending on whether somebody's employed or self-employed. So if you wouldn't mind talking us through how you see it working for your clients.
Yeah, definitely. So tax relief is given subject to the annual allowance, which is the overriding limit for tax relief on pension contributions. It is given based on the gross pension contribution at an individual's marginal tax rate. So this means broadly that anyone earning under £50,000 a year generates tax relief of 20% on pension contributions. Anyone earning between £50,000 and £125,000 a year generates tax relief of 40%. And anyone who earns over £125,000 a year generates tax relief at 45%. Now, basic rate relief is almost always given at source and paid in directly into the pension pot, but what many clients don't understand is that actually the higher and additional rate tax relief, so the additional 20 and 25%, to bring it up to 40 and 45% respectively, that needs to be claimed by the client either on the tax return or a standalone claim. So we see it from time to time with new clients that they haven't actually claimed the tax relief on their pension contributions in prior years. And the key thing to look out for is that you've only got 4 years from the year the pension contribution is made to go back and claim that relief, otherwise it's lost.
I think there is a bit of perception, isn't there, that HMRC will contact you if you're due that relief,
Yeah.
as opposed to you having to actually do anything about it.
Yeah, unfortunately it's not that simple, and the onus is very much on the individual to make that claim. So let's put the numbers together in a case study, a short case study. So let's take a fictitious client, let's call her Isabel. So she's got a salary of £90,000 per year, and she makes a pension payment into her SIP of £10,000, so a pension contribution outside of her payroll. Now, what HMRC will do is provide the basic rate tax relief at source, so they will top up that £10,000 of pension contribution to £12,500 by paying £2,500 directly into Isabel's pension fund. Now, what Isabel needs to do is either on her tax return or a standalone claim is claim the higher rate tax relief she's due because she pays tax at 40%. Now, when she does that, she will receive an extra £2,500 of tax relief. And overall, what this means is that Isabel has ended up with a pension contribution of £12,500 in her pension fund, but it's only cost her £7,500.
So it's very cost effective, isn't it, compared to other savings?
Yeah, exactly. And it sort of demonstrates the power of the tax relief and how you go from the net £7,500 paid by Isabel to £12,500 in her pension fund.
So in terms of what you've just said, Neil, obviously getting the relief, whether it be at 20 or even 45%, is very attractive. Is that the maximum level of tax relief that any individual can have if they pay into a pension?
Well, there is a niche scenario, and there's an opportunity for those earning between £100 and £125, £140 to generate a higher rate of tax relief of up to 60%. Now, this is all to do with the interaction that pension contributions have with the personal allowance, which applies for income tax. So the personal allowance of £12,570 currently is the amount that you can earn tax-free in a year. Now, once your earnings exceed £100,000 in a year, for every £2 they exceed £100,000, you lose at £1 of your personal allowance. Now, this means the window of earnings between £100,000 and £125,140 are subject to a rate of tax of 60%. So whilst that is a high rate of tax, it does give the opportunity for the pension contributions to relieve that high rate of tax. So let's go back to our case study, Isabel. So let's say she's had a promotion and now she earns she did earn £90,000 a year. She now earns £120,000 a year. So she makes the same £10,000 contribution. Now, the 60% tax relief sort of comes in 3 ways. There's the basic rate tax relief of 20% that HMRC pay directly into Isabel's pension. There is the 20% claimed through her tax return, as I said in the previous example, due to her paying the 40% rate. And there is 20% tax relief on the pension contribution through the recovery of her personal allowance, which no longer is tapered to the extent she makes a gross pension contribution. Now, just to summarise that again, if Isabel makes the same £10,000 contribution, she ends up with £12,500 in her pension again, but it actually only costs her £5,000 in this instance, and that's because of the 60% marginal rate of tax relief. Now, of course, once the funds are within the pension, they roll up tax-free as well, so income and gains will not be subject to tax, and this can mean that she will get a higher rate of return in the long run.
And I guess as well, when we've been working with clients, there can be times like that where people may be in that income bracket. There's an opportunity there that may not continue forever, particularly if somebody's income is likely to be increasing. So it's quite opportune for some clients, particularly if they can get that 60%, to maximise them when they can, where in the future it might not be possible.
Yeah, exactly. I mean, clients don't often react well to you telling them that they're in the 60% marginal rate of tax.
Yeah.
So this is a good opportunity to relieve that through pension contributions. So it's definitely some good planning that can be done to bring down the tax rate.
Yeah. Okay, thanks, Neil. Trevor, we've talked before about how pension tax relief can be very valuable for UK taxpayers and those that are UK resident. As we know, for US citizens, often things aren't always as straightforward. When it comes to UK pensions and tax relief, how does that work for US connected individuals? Can they still obtain the relief on UK pensions?
Well, Rachel, there are no equivalent US tax breaks for UK pension plans per se. So personal contributions are not deductible. Any employer contributions would be taxable in the US. Now, that may not actually matter at the end of the day on a person's US tax return because of the operation of foreign tax credits. So you probably won't end up paying any additional US taxes. Then once the contribution is in the plan, then for US purposes, the amounts would roll up tax-free for US purposes. There'd only be a US tax point then when there's a distribution from the plan. But the big issue, the big problem, is that there are significant additional US filing obligations each and every year in respect of personal plans, be they self-employment plans or personally funded plans. So it can be quite expensive to deal with the accounting on the US side in respect of these plans, but it's even more expensive if one doesn't file the reports and then subjects oneself to the IRS penalties. There can be penalties up to 35% of contributions to the plans if one does not report that contribution to the IRS in the right manner.
And I guess a lot of the time, certainly in our experience, when clients come to us as new clients, it's often they're not reporting because they don't think that they even need to, otherwise they're just doing what everybody else that they work with is doing, either paying to their own pension or their employers.
Absolutely, it can come as quite a shock, quite a kind of a rude awakening to them. And in many situations we've had to go back to the past, correct prior non-filings. There are certain US IRS programs which will allow people to get back on track with any prior non-filings and only have to file a handful of the most recent 3-year returns, for example, as opposed to going back for 5, 10, 15 years.
Yeah, but I suppose the key thing is if they are funding a pension and getting the UK relief, that they're taking advice on how to do it properly from a US angle as well.
Absolutely vital, otherwise that could be a very expensive omission.
And when it comes, just fast forwarding a little bit, Trevor, when it comes to retirement, if US connected individuals are then drawing down on their pension funds, whether it be while they're here in the UK or the US, how does that work? That's presumably a piece of cake?
Well, almost actually, funnily enough, Rachel. Here the answer is not at all bad. I mean, certainly to the extent that an individual can take out a lump sum from a UK plan tax-free, so the 25% element, then broadly speaking, if one files the return in the correct way in the US will recognise that 25% lump sum tax-free amount. It won't be taxed in the States. One word of caution, if somebody's living in a US state at the time, then that state may apply a tax liability. Prime example of that would be somebody living in California.
Okay. So you mentioned the lump sum, but obviously, as we know here in the UK, people may take a lump sum or they might decide to take some income or a bit of both. How does that work if somebody's taking regular, I think you call them periodic payments? Yeah.
If people are taking periodic amounts, it really depends upon where they're living. If you're living in the UK still, then broadly speaking, the UK will tax the periodic income. The US will tax it as well, but the US will give credit for the UK liability, so there'll be no net US tax.
Okay.
For a person who's moved back to the US when they start drawing down on their pension, then the UK won't tax it. The US will tax it, but the person may have basis in the plan. They may be able to utilise carried forward foreign tax credits. So it may not actually cost them the full level of US tax. So there may be some benefits there. Once again, very important to consider the state tax consequences as well.
And I suppose, as you alluded to, in terms of how it could be quite tax efficient in the States, that also depends on how it was reported and if it was done in a certain way back when, really.
Absolutely.
So, yeah.
You really do need a joined-up solution for this.
Yeah. Okay. So I guess with many of the changes, would it be for UK or US citizens, there are obviously opportunities there from a planning point of view, but I think you probably agree from when it comes to the US side, it's very much a case of taking advice on an individual basis and your future plans, really, before deciding whether it's to fund pensions or to draw from them.
Absolutely. Opportunities, potential pitfalls. Every situation is different, as you say. There's no one-size-fits-all answer here. The real advice is ask an expert.
Okay. Which I'm guessing is you, Trevor.
Is the correct answer.
Thank you, Trevor. So we've talked about the benefits of pensions in terms of tax benefits and also the rule changes. But Ben, just turning to you, in terms of the monies that you've built up in a pension, from the point of view of passing on wealth, what typically happens on death to your pension?
Okay, well, there's a lot of flexibility in the rules to allow pensions to be passed on death. Not all pensions can be passed on death. It does depend on the type of arrangement, but keeping it simple for this session, personal pensions can be left to beneficiaries on death, and it's the full value of the pension that can be passed on. So this leads to kind of opportunities for planning to use the pension vehicle as a way of storing wealth and passing it on to loved ones free of inheritance tax. Now, the situation on death before 75 is that the full value of a pension pot can be left to beneficiaries free of tax. That's completely free of tax, free of income tax and inheritance tax. And an individual can choose to nominate beneficiaries, specific individuals they want to receive their pension benefits on death, or a charity or a trust. So there's lots of flexibility to control how pensions are used on death. Now, the position is slightly different should the individual pension member pass away after age 75. In this instance, the value of the pension can still be left to their nominated beneficiaries free of inheritance tax, but if they've nominated individuals to receive the pension, those individual beneficiaries will be subject to income tax should they draw from their inherited pension. Now, they don't have to draw from the pension immediately. They could choose, if they wanted, to retain the pension wrapper and choose to defer drawing on it for a period until perhaps they reach retirement, and they will be able to use their inherited pension as an income source in retirement. And could be that at that point they're not a higher rate taxpayer and would pay basic rate tax to draw on the pension. And in the interim period, the inherited pension wrapper will allow them to accrue investment growth tax-free. So an inherited pension is a particularly attractive way of passing on wealth through generations.
Sounds very tax efficient, and interesting on the inheritance tax point, because obviously that wasn't always the case. So it's certainly become more flexible. But on that point, Neil, does that apply to all pensions? So there's no inheritance tax whatsoever as far as any individual is concerned?
So generally speaking, inheritance tax is not a consideration when there's pension contributions or benefits, and that's why they can be used very effectively as an estate planning tool. However, there are some instances where you do have to think about inheritance tax, so it's not quite as simple. So, for instance, in respect of pension contributions, if these are made by a member who is in ill health, then he or she could be considered to have a transfer of value for inheritance tax purposes, and HMRC particularly scrutinise any pension contributions within the 2 years prior to a member's death. In respect of pension benefits themselves, there are certain scenarios, again, that could attract inheritance tax. So retirement annuity contracts are one of them, where there is a legal right to a payment to go into a deceased member's pension fund, or a transfer of value of a pension between two providers. That can also cause inheritance tax as well, particularly where, again, the member is in ill health. So generally, yes, inheritance tax is not a consideration for pensions, but there are a couple of scenarios where it is, and so you do need to take a bit of care and also a bit of planning as well.
Okay. And as you know, Trevor, obviously we have a lot of clients that have a US connection here in the UK, and we've talked before about how the tax relief might work. So presumably on the inheritance tax side, it's all very straightforward and the US isn't interested.
No such luck, Rachel, I'm afraid to say. These are UK plans, so they're non-US plans. Therefore, the US will tax them. Yeah. So the value of the plan will be included within the individual's worldwide estate at death, and therefore potentially be liable to US estate tax. That's the bad news. The more encouraging news is that currently the US estate exemption is some $13 million. So a significant amount of money here. So basically, if a person's combined estate, including the pension, is less than $13 million, and they've not eaten into that exemption during their lifetime, well then there'll be no net US estate tax to pay. Now, one word of caution, $13 million is the current amount. That is scheduled to half in 2026.
Okay. So obviously we've talked about how we can pass on wealth through a pension tax efficiently and with your caveats as well, Trevor, in terms of US citizens. Are there any other planning opportunities, Ben, using pensions specifically, where people can pass on wealth if they wish to?
Yes, Richard, I think there are a number of planning opportunities for the use of pensions as an estate planning tool. Obviously, pensions, as we've identified today, offer tax-efficient investment opportunities, and there can be no inheritance tax on pensions on death. So one potential opportunity for the use of a pension as an estate planning vehicle would be to for an individual, let's say, who reaches retirement with a pension and other assets. So if we're saying the pension is free of inheritance tax, the other assets in their estate could be possibly subject to a future inheritance tax charge. And if they wanted, they could decide to defer drawing on their pension in retirement and instead draw on the assets in their estate, whether that be ISAs, taxable investments, or perhaps rental property. And the net effect of this would be the pension is left to grow, and this will maximise the value of the pension in the long run. And they'll be drawing income from their taxable estate, which will suppress the value of that and could even lead to a drawdown in value over time, which will reduce the ultimate inheritance tax liability on death.
It's an interesting point, isn't it? Because people often, I think, certainly with our clients, they start off often thinking pensions are the default, where you start drawing income from first, rather than necessarily just seeing them as another asset, really.
Yeah, quite. And I think that's the key thing, is that pensions are ultimately a tax wrapper. And the way you invest in a pension, it obviously depends on the individual, but there's lots of flexibility now to invest. And if you're taking a long-term view, the pension isn't necessarily there just to provide income. And another planning opportunity available for the use of a pension would be to try to maximise contributions to a pension in your lifetime, or possibly even to make contributions for family members. So pension contributions aren't limited to earned income, and therefore pension contributions don't have to stop at retirement, so you can carry on paying into your pension in retirement. Contributions are limited where there's no earned income to £3,600, but the £3,600 contribution will receive basic rate tax relief of 20%. So it would only cost an individual £2,880 to pay into the pension, so they're receiving £720 of tax relief on that contribution, and wealth's being moved into the pension wrapper where it's free of inheritance tax. Now that option is available for the individual to pay into their pension, but they could also pay into family members' pensions, perhaps a spouse or partner or children or grandchildren, and the same allowance is possibly available if the potential beneficiary isn't already using their allowance. So that obviously offers opportunity to store wealth or to pass on wealth through gifting into family members' pensions. Now, one important consideration if considering gifting into a family member's pension is that the beneficiary of the gift won't be able to access the benefits within their pension until they reach age 55 under current rules, which could be a long time period for younger beneficiaries. Another limiting factor in the past has been the lifetime allowance, and any contributions to children or grandchildren, maybe in their 20s or 30s, would have had a number of years of investment growth. And it could have been that the growth on the value of the extra contributions from family members, as well as the value of the contributions themselves, could have meant that the individual child or grandchild would have breached their lifetime allowance at some point in future. Now, the recent rule changes to the lifetime allowance could remove this issue, but it is still an important consideration, I think, for the longer term.
Okay.
Yeah, that's a good point, Ben, because this makes family contributions a possibility again, and particularly for those parents who perhaps have children who've reached working age and have a salary, where they're not restricted to the 3,600 gross contributions. So if we take an example of a parent whose child has reached working age and is earning £50,000 a year, now understandably that child might not have the level of available income to utilise their annual allowances for pension purposes because they've got other costs to meet, such as rent or general living expenses or saving for a property. Now, if they were to contribute, say, £5,000 along with their employer into the pension, there'd be £45,000 of unused allowances and therefore capacity for a parent to make a contribution on behalf of that child. Okay, so if they were to do that, they could make the net contribution and then HMRC would pay the tax relief directly into the child's pension fund. That would be the basic rate tax relief. So if the child is a higher or additional rate payer, you could potentially get higher rates of relief of 40 and 45%. Now, one thing to consider when you are contributing to somebody else's pension fund, of course, is inheritance tax. So generally, large pension payments into a contribution to somebody else's pension will result in a potentially exempt transfer for inheritance tax. Now, what that means is the person who made the contribution must survive 7 years from the date of the contribution in order for it to be free from inheritance tax. For smaller pension payments, there are reliefs and exemptions that might make them exempt from inheritance tax immediately, or there is a valuable exemption if the parent is to make the contribution from excess income. So it could potentially mean that the payment into the child's pension fund is free from inheritance tax with immediate effect.
That's an interesting point, Neil, when you're saying it in terms of the regular income. So just to run through that and see what it looks like in terms of the tax relief and the cost. If we were to look at, say, an individual where the parent is paying in, say, £1,000 a month into the child's pension, can you run through what the tax relief work looks like from the overall family perspective?
Yeah, definitely. So if you take your example of £1,000 per month, that's £12,000 per annum. Now, the first step would be that once the £12,000 net contribution is made, HMRC paying the £3,000 of basic rate tax relief directly into the child's pension fund. Mm-hmm. And now, assuming that the parent benefits from the surplus income exemption for inheritance tax, that's also a £4,800 inheritance tax saving. Now, what this effectively means is there is a rate of tax relief across the family of 65% for a basic rate taxpayer. Now, if the child is a higher or additional rate taxpayer, you can get higher rates of relief of up to 90 and 96.25% respectively, so very high rates of tax relief.
So it can be very tax efficient, particularly, as you say, if the child has relevant earnings as well.
Yeah, exactly, and that's the key, that the child in this case has relevant earnings, and so this opportunity is available to the family.
And I think one of the key considerations for use of pensions by a family is not just making the contributions, but also how to invest within the pension wrapper, and where you've got multiple parties to that decision, thinking about how to invest is perhaps more difficult, but also it's still important. And over the long term, investment growth will increase the value of wealth stored in the pension and can further improve the benefits to children and grandchildren.
So as we've talked about, looking at this in detail, pensions obviously offer a lot of planning opportunities, whether it's on the tax relief or retirement or passing on wealth. And I think particularly the pension rule changes have meant that there's certainly a need for advice there in terms of what's right for individual situations. However, what we obviously do need to be careful, and we certainly have in mind, is that these rules can change, not just in terms of pension limits, but in any areas that affect pensions, so that any advice is reviewed and people should take careful consideration, I think we'd agree, before making any decisions. I'd like to thank you all today for being here and giving some really helpful insight, I hope, on the various planning points.
Thanks very much.
And thanks to everybody as well who's watching today. We're also going to have further sessions in due course, and we have material as well on our website and insights on topics such as this. So please do have a look and contact us if you have any queries.